A lot of businesses mistake profit and cash flow for being the same thing. It's not. I repeat, cash flow is not the same thing as profit. Getting this wrong can be the sole reason your business fails. Because over 90% of businesses fail because they run out of cash, not profit. Here's the truth. There are many unprofitable businesses that are still standing, but I can't name one business that ran out of cash that is still here today. Hi, my name is Sherman, a CPA with Life Accounting, a full-service accounting firm that helps small businesses grow and manage their finances. In today's episode, I'm going to break down the difference between profit and cash flow. By the end of this video, you will not have to think twice about the difference between cash flow and profit. Also, if you're new to our channel, then please be sure to subscribe so you don't miss out on future videos that can help you grow your business. Also, if you extract any value from this video, then please help me out by hitting that like button below. With that said, let's talk about cash flow versus profits. So what in the world is cash flow? Cash flow is simply the flow of cash, aka money, paper, bread, cheddar, and so on, that goes in and out of your business. Most people look at cash flow in terms of positives and negatives. A positive cash flow means that your company is adding more cash to your account than it's losing. While a negative cash flow means that your company is burning more cash from your account than is adding. Now, a positive cash flow is obviously ideal, but many business owners get this confused with profit. Okay then, so what is profit? Profit is the financial gain or loss between the amount of money you earned and the amount of expenses you incurred. These two words, earned and incurred, is the biggest difference between cash flow and profit. You see, you can earn money but never receive cash for it. For example, you can cut someone's grass and technically earn their money. But if they don't have the money to pay you, then you will not receive any cash despite you earning that money. Likewise, you can owe money for expenses but never actually pay it. For example, I had a client that loved to pay me late, like very late, like months late at a time. I hated it. I'd perform a service for him and he'd write me a post-dated check that I could not cash for weeks on end. But the reason why he did this was to manage his cash flow. He delayed paying his expenses because he did not want to jeopardize his cash flow and ultimately mismanage his business. The biggest mistake business owners make when assessing their financial health of their companies is that they put too much emphasis on the income statement, also known as the profit and loss statement. However, this statement only shows you the revenue you earned minus the expenses you incurred. It tells you nothing about the lifeline that keeps your business open, cash flow. So instead of just looking at the profit and loss statement, which is revenue minus expenses, you should also look at your cash flow statement. But before I go into the cash flow statement, you need to understand how cash flow is calculated. Okay, so how is cash flow calculated? To calculate your cash flow for a period of time, start with your opening cash balance. This should be the balance that is in your business bank account. Then add all of your cash inflows to that account minus all cash outflows to your account. Now, when looking at your cash flow, you need to forget about all the money you think you earned or that you expect to receive. Your current cash flow standing is right there in your bank account. That is your current reality. Nothing more, nothing less. Okay, so what is a cash flow statement? A cash flow statement is a statement that outlines the cash flow in your business. Now, ideally, you will look at your cash flow statement every single month. And when you're looking at it, the report is typically broken out into three major sections: operating activities, financing activities, and my favorite, investing activities. Operating activities are cash inflows and outflows from normal operating activities inside of your business, like receiving cash from customers or paying cash to suppliers. Now, financing activities are cash inflows and outflows related to financing your business, such as receiving money from loans or paying interest on those loan liabilities. And investing activities are cash inflows and outflows related to purchasing assets for your business, like buying property or equipment that will be utilized for some period of time. So that's what cash flow is and the major components of the cash flow statement. But what if you don't have access to a cash flow statement? If you're unable to generate a cash flow statement, then I'd recommend you look at your profit and loss statement on a cash basis. This is another way to gain some understanding of your business cash position. Typically, there are two ways you can look at your profit and loss statement: on an accrual basis or on a cash basis. An accrual basis financial statement does not account for your cash flow at all. It simply looks at revenue you earned minus expenses you incurred. A cash basis financial statement does account for your cash. Cash coming into your business would generally be considered revenue, and cash leaving your business would be considered expenses. Unless it's not, of course. You can still classify loan payments and bank transfers as balance sheet items, since those are liabilities and assets. Okay, with that out of the way, how can you bridge the gap between your profit and cash flow and ultimately increase your cash flow? There are a list of things you can do to improve the cash flow in your business, so much so that I will have to create another video to go over all of it. So be sure to subscribe to our channel. But here are the major things that I'd recommend. Number one, of course, look at your cash flow in the first place. If you don't understand your cash flow, then nothing else I tell you will help. Number two, find ways to increase your speed of collections. For example, instead of sending invoices for services or products you sell, ask for an electronic form of payment from your customers so you can charge them right away. Number three, find ways to decrease your speed of payments. For example, you can negotiate payment terms with your vendors to pay them after services are rendered or after 15 to 30 days, which is standard for many vendors. But if you're anything like me, then you probably hate owing people money, and therefore, I'd only delay the speed of paying people as the last resort to managing your cash flow. All right, now that you understand the difference between cash flow and profit, let's quickly recap today's episode. Today, we define the difference between cash flow and profit. Remember, profit is the financial gain or loss between the amount of money you earned and the amount of expenses incurred, while cash flow is simply the flow of cash in and out of your business. To understand your cash flow, look at your cash flow statement every month or a cash basis profit and loss statement. All right, folks, that's it for today's episode. I hope you found this video useful and interesting. If you did, then please go ahead and give this video a thumbs up or comment below with any questions you have. Also, don't forget to subscribe to our channel so you don't miss out on other accounting content we're putting out there to help you grow and manage your business. Until next time, take care.